Hi viewers, welcome to the channel. In this week's video I'll be covering the tourism sector and the headline here, now that the vaccine is coming, or vaccines are coming, is it now time to buy into tourism stocks? Not many things really to show here, except I guess the charts are the most important. This is a 5-year chart showing Flight Centre, Webjet, Qantas versus the ASX 200 accumulation index. Probably could have shown a little bit of a shorter one to show the impact of COVID, but certainly you can see in the early days, Webjet was the superior performer, which is, showing the benefits of being an online-only platform. Has grown very, very quickly. But, Qantas and Flight Centre certainly held their own versus the broader market. Then, of course, COVID came in February and March of this year, and Webjet fell to earth very quickly, as did both Qantas and Flight Centre, and so too did the ASX 200, but on a smaller, by a far smaller amount. Now, this is, I guess, the interesting part, because many people I speak to and many analysts I read now say, well, here we are now, the market's starting to recover, not too far from its highs, and look at where Flight Centre is, look at where Qantas and Webjet are. And I think that is definitely a point to be made, but I think it misses the point to some degree as well. I think you've clearly seen these stocks bounce a long way. Webjet was in the ones, and now it's in the fives and almost $6. Flight Centre and Qantas also well off their lows, and that's. Equities are forward-looking. There's no doubt that the markets are now pricing in a return to normal. I would say at some point in 2021. These are three businesses that do rely on international travel as well. So perhaps I think the optimism about international travel resuming, at least en masse, in 2021 is probably overly optimistic. But a much brighter domestic tourism business environment will be great for all three of these as well. And look, as we've seen from recent commentary from Qantas, to some degree, the fact that people can't travel overseas means that demand for domestic travel will probably be greater than they've seen. And Qantas said that their demand that they're seeing is pretty incredible. But you're missing the key factor here, is that all three of these companies, understandably, when times were a lot more uncertain, when no one really knew how long this pandemic was going to last, all three of these companies conducted very dilutive equity raisings. In the case of Webjet, they did that at $1.70, effectively doubled their shares on issue. And in the case of Flight Centre, also that was at $7.20, also roughly doubled their shares on issue. Qantas was a little bit less, but also diluted their shares. So what you're now seeing is that for Webjet to go back to where it was, its previous highs, it's now on effectively twice the amount of shares on issue, and there's no way that these companies are going to be earning twice what they were pre-pandemic. It's likely that none of them are going to be making what they were for some time. And the fact that there are extra shares on issue, I think, needs to be taken into account. So Webjet, which is around $6 right now, for example, the fact that they've raised money at $1.70 and almost doubled their shares on issue at that level, it's almost back near its highs. So factor that in to your analysis of whether these are worthwhile buying. I do think there are areas of the market that do offer attractive buying as exposure to that vaccine story and a return to normal. But probably these three. Maybe Qantas would be the one I'd be leaning towards buying the most, but Flight Centre and Webjet, they have their reasons why they shouldn't go up too much. The next chart I've shown is Sydney Airport versus the ASX 200 accumulation index, and the reason I've shown this one is because I think this is the real can't miss of the sector, at least over the long term. It's like the broader market fell very hard. It fell harder, of course, because its business was demolished. But this is a monopoly asset in Australia's best city for travel, and also I should say a very long-dated lease, and the balance sheet that can withstand a period of turmoil. This is a business that will recover. It's only a matter of when. And to be able to buy such long-dated assets as Sydney Airport at a discount in an environment of lowering interest rates, when it is effectively a bond proxy during regular times, I think is fantastic. So it's around, I think, $6.80 or so. It was above $9 before the COVID hit, and I think this is the sort of stock that if you want to play a recovery, it's far lower risk, and I think as a long-term investment remains very exciting. Anyway, that's it. Thank you for listening in. If you like this video, don't forget to like and subscribe, and we'll be back next week with another video.